terms of derivatives. One of derivatives we reviewed that are this kind of financial instrument with an underlying asset. So basically, this underlying asset has a value, but the value of the contract is determined to other variables like interest rate or market indices or even goods. So the first type of derivative securities is future. Are futures. So futures are contracts. Basically is an agreement between two parties for the purchase and delivery of an asset at an agreed upon price at the future date. Normally, futures are traded in formal markets. It's for that reason that this kind of derivatives have standardized contracts. I mean, because obviously the formal market is very big. For that reason, to be more flexible and be more effective, these contracts are already standardized. So in future, the parties involved have the obligation to buy or sell the underlying asset. We are going to review an example in forwards because basically forwards and future is the same operation. The difference between forwards and future is that in futures, we have a formal market, but in forwards we don't have a market. So normally these forwards operation are done in a market called over the counter. Forwards contracts are similar to future, but as I told you, they don't have a formal market. So for that reason, the market of forwards is called over the counter. Over the counter because it's in a retailing sector, and same as future. When a forward contract is created, the buyer and seller must determine a turn size and the process, because, for example, in future, the contract in future has all the terms in the contract, that the terms are already written in the contract. But in forwards, because this market is small, the participants on these kind of derivatives have to create the contract with condition, with size, with process. Let's review an example. For a farmer, imagine that we have a farmer that this farmer has onions. And this farmer is very worried about the volatility in the price of onion. Maybe the farmer is thinking that the price of the onion is going to decrease. And obviously, if he is producing onions, obviously he feels very concerned about if the price decrease, the price of onions. So for that reason, this farmer creates a forward contract, no? So a contract to sell 100 kilograms of onions to ABC firm. 40 pounds or $40 is the strike price that will be sell or buy in the future. ABC firms must have entered the contract as it thinks the price of onions will be greater than 40 pounds. So In the case of the farmer is concerned if the price of the onion decrease. But in the case of the ABC firm, this firm is expecting that the price of the onion increase. For that reason, maybe ABC company could think, okay, I'm going to create a contract with this farmer because I know that probably the price of the onion is going to increase. And if now in the present, this farmer is selling me the kilogram of the onion in 40 pounds, so this is convenient for me because I'm expecting that the price of the onion increase in the future, but not for the farmer. Obviously, the farmer is thinking maybe the price of the onion will be decreased. And when we are thinking in the both sides, we can create a forward or a future contract. Remember, forwards are in over the counter and future are trade in a formal market. And when this month of this year or the time pass, obviously the two parts are obligated to sell or buy. It doesn't matter if the price increase or decrease, they are obligated to sell the underlying asset, in this case, the onion. So in the future, maybe the farmer will be a profit or want, or ABC firm could have a profit or not. All depends on the volatility on the price of the onion. Now let's move on to see the option. Option is another type of derivative securities. So in option, it's not the same, obviously, as forwards and futures. In options, as the name has implied, is to decide if we want to buy the underlying asset or not. In this kind of contract, the parties are not obligated to close the deal. So for that reason, we have two types of option. We have call option and put option. Call option offers a right to buy the underlying asset at a predetermined strike price. In this case, if we remember the example of the onions, the strike price would be the 40 pounds per kilograms in a particular day with any obligation. And also a call option, the investor is anticipating an increase in price. So for that reason, a call option has implied buying, because obviously if the price increase and in the present we have an option contract, it doesn't matter if the price of the onion increase. Now in the present we have set a price that is 40 pounds per kilogram of onion, so it doesn't matter if the price increase. So for that reason, the part of in the transaction that is going to buy is expecting that the price increase, because now the price of the onion is 40 pounds, but probably in the future will be 50 pounds. So for that reason, this call option is the option to buy this underlying asset in a small price than in the future. Another feature of a call option is profit. The profit is unrestricted. So the price of the onion could be 50, 100. It doesn't have a ceiling. So the price could increase or the price could decrease. In this kind of transaction, there's no any limit. And opposite to call option, we have put options. In the put option, it offers a right to sell an underlying asset at predetermined strike price on a particular date. So in a put option, basically is the same as in a call option, but is the right, in this case, to sell. So a put option could be for the farmer. For the farmer, if the price of the onion increase, imagine that at the beginning the farmer is offering the onions, the kilogram of onions in 40%, in 40 pounds, but in the future, this farmer realized that the price in the onion increased, like maybe 100 pounds. So obviously, this situation is not going to be convenient for the farmer. So probably the farmer at the end, he could decide, okay, I'm not going to sell my onions in 40%, but because now the price has increased. Or imagine, and the other characteristic is investor anticipate a fall in price. So again, keep in mind the example of the farmer. So the farmer is expecting at the beginning, when the option contract is creating, the farmer is expecting that the price of the onion decrease. For that reason, now in the present, the farmer is offering the onions in 40 pounds because he is concerned probably in the future, the price of the onion decrease, and maybe now I can get 40 pounds, but probably in the future, only I can get 30. So for that reason, the investor in a put option are anticipating a fall in the price, in the strike price, no, or in the underlying asset, in this example, onions. And limited profits as a price decrease would eventually be arrested at zero. So it's the same as a call option. We don't have a limit. Even the price could be zero. Maybe in the future, the value of the onions could be zero, and it would be very convenient for the farmer. Agreed a contract in which he can get 40 pounds. But obviously in this transaction, all depends if there is an investor that want to buy this onion. An example of an option. Let's move on to another example, apart from the onion example. You expected a company X, Y, and Z said a stock price go to up 90 pounds with the next month. So we are in the present and we are expecting that the price of something is going to increase. You find out that you can buy an option contract for this company at 4.50 with a strike price of 7.75 per share. So we are expecting that the price of this share is going to increase in the market to 90. But now we have the option to sign off an option contract in which the price could be 75. And for this contract, we need to pay 1.50 per share. So we are going to buy 100 shares. It means that 4.50 multiplied by 100 share, we are going to pay only for the contract, only for the option contract, for 150 pounds. And additionally, we are going to buy the 100 share multiplied by 75 per share. So it's important to notice the difference. One price, this price, 450 is only to do the contract, and this is the price of the shares. So the stock price begins to rise as you expect and stabilizes at 100. So we were expecting that the price in the future will be 90, but the price increased even more than 90. It increased 100. Prior to expire the date of the contract option, you execute the call option. It means you buy you buy the option. So you have now a underlying asset, and you realize that this asset, now the value of this asset is 100. So for that reason, you want to buy a 100 shares of the company X, Y, and Z at 75 the strike price, because in fact the cost of the share for you that you have this option contract is not 100. For you, the contract, the price of the share is 75. So you decide, okay, it's convenient for me, execute my option contract, because in my option contract, the price is 75, even when in the market is 100. So you have the option to buy, to execute this contract in £7,500. Now you has executed the contract, so now you get 100 shares in 75 per share. So now you have expend 7,500. So now you need to sell these shares, because now the market is telling you that the value of these shares is 100. So when you execute a contract, now you can sell your shares in 75 per share in 100 per share. So now you are executing a put option in which you are selling your option. It means that you can get a profit of £2,050. Why? Because first, the value of the shares in the market, the value of the 100 shares in the market is 10,000. But because you have an option contract, you pay for these shares that now in the value in the market, the value is 10,000, but only you pay £7,500. So 10,000 minus £7,500 minus 450, because this is the value of the contract, this is the cost of the contract, you have a profit of £2,050. So basically, if you can see, the option operation are very fast. You need to buy, you need to execute your option contract, and in the same moment, you need to realize if you want to sell your shares or your underlying asset in order to have a profit very soon and take advantage of the conditions of the market. Now, let's review the last type of derivatives. These derivatives are called swaps. Swaps, basically, they don't have an underlying asset. The underlying, the thing with swaps is that the parties exchange future cash flows. They are not exchange underlying assets. They are trading money, trading cash. So the most common type of swaps is called interest rate swap, because normally the parties exchange one kind of interest rate to another kind of interest rate. So, for example, Bank A has a loan, and this loan has a fluctuate interest rate. It means it's not fixed. Normally, this kind of rate, interest rates are moving according to economic condition. So if the economic condition is good, probably you could pay an interest rate very, very small. But if the condition in the market is not very good, or is very Volatile, it means that the interest rate could be very huge, and obviously it implies that if you have a loan with a flexible interest rate, if the interest rate increase in a bad condition, in a bad economic condition, you will pay more interest. This is convenient, obviously, for some companies, for some investors, but for others, it's not very convenient because it's not sure. Because in fact, the companies, the banks, or the investors are playing with the economic condition, with many factors that we don't know. It's risky, but at the end, you can get a lot of benefits if the conditions in the economy are good. So in the example, we have a bank A with a flexible interest rate, and we have a bank B, in which this bank, we can find a loan that pays a fixed rate of interest. So a fixed rate of interest is an established interest rate that doesn't change if the condition in the market change. The fixed interest rate will be always the same. So a swap contract, bank A and bank B could establish a swap contract in which they change the interest rate. So the bank B will receive the interest, the interest based on flexible condition, and the bank B is going to receive the interest in a fixed rate condition. But be careful, because we are in swaps, we are talking about only the interest. These two banks are not exchanging the loan, they only are exchanging the interest rate. For that reason, the main characteristic of swap is that in swaps we can exchange only futures cash flows. So I like this graphic because this graphic shows a return on risk. So we have here return and we have here risk. So bonds or debt securities are the less risky securities, because even when we don't have a lot of returns, we don't have risk. Hybrids are a little bit more riskier than bonds. Obviously, they are offering more returns, but it's according to the risk. And equities are the riskier securities in the market because it offers a lot of returns, but also it implies equity security. It could implies a huge risk too. Now we are going to review where are the securities in a balance sheet. We are going to review in different sides. One according to the investor, another according to the company that is emitting debt or shares or other kind of security. Let's think that we are the company that is emitting debt or is emitting securities, equity, common, preferred equity securities. So if we are the company that is emitting debt securities, debt securities are going to be here in the liabilities, and equity will be here in equity, because remember, in a balance sheet, this side of the balance sheet shows all the obligation of the company. So why is an obligation a debt security? Because the company is receiving money from an investor, and in a certain period of time, the company needs to return this money. For that reason, is an obligation. Same as equity, no? The company is receiving money, and in certain period of time, the company needs to pay dividends. So this is an obligation. For that reason, liabilities, debt securities will be here, and equity securities will be here, no, because are obligations. Now let's think that we are the investor. We are the part that is giving the money to this company. Where will be this investment? This investment will be here in the assets, because remember, this side of the balance sheet, the asset side shows all the rights that we have. So we give our money and we have the right to receive the money again, plus a dividend or plus an interest rate, plus a return. So if we are the investor, or our investment will be here in the asset side, because it's a right that we have. Now, let's move on to associated concept. One of the concepts that I have mentioned during this lecture is centralized exchange, and the other concept is over-the-counter, that now I know that you know a little bit more about over-the-counter. Centralized exchange. This is a financial market structure that consists of having orders routed to one central exchange with no other competing market. It means a centralized exchange is the only market in which we can trade a security or a financial instrument. And for that reason, because it's the only market that we have to exchange securities, decentralized exchange normally is very regulated in order to protect the interest of the investors, and to guarantee that the trades held on this kind of centralized exchange are fair. And another benefit of a centralized exchange is boost the business and have a very, very transparent and fast buying and selling process. The other concept is over-the-counter. Over-the-counter refers to a process of how securities are traded via broker and dealer. It means that we don't have a market. They are trading face-to-face. We don't have to go to a market to trade our assets. In this kind of concept, over-the-counter in this kind of market, broker and dealer, the parties are creating the contract to do the operation. Over-the-counter market are created because many reasons. One, because probably there's no a market in which we can trade a determined asset. So maybe centralized exchange, they doesn't have this one kind of assets, of securities, and for that reason, the parties that want to operate together needs to have a market, but this market is so small. So for that reason, they trade face-to-face. And other reason why over-the-counter exists is because normally companies, not all the companies can cover all the requirements that centralized exchange asks for. So probably because they don't have enough money, they don't have the size required for a stock market, for a market exchange, or for many reasons. And because these companies that want to trade assets don't cover listed requirements, for that reason, the easy way to trade asset is over the counter. Now we have a broker and a dealer. These are very important concepts too. A broker, we have basically is a person that trades orders on behalf of the clients. And for example, we have one kind of broker that is called full service broker, that is a personal broker for one person. And we have another kind of broker that is a discount broker that this guy has the right to act on behalf of the client, even without the speaking to another person, no? So broker basically are these people that are trading assets in a market. And the opposite part is a dealer. Dealer could act not like a broker, only on behalf of a person. Normally, dealer could act on behalf of its own interest. The best example of dealers are investment bank, because they are trading their oral or their own interest, their own money. So the dealer, if I have the money and I want to trade, and is my money, is my investment, I can be a dealer, no, because I'm acting by myself. And here I have another example, another image that reflects how the transaction in securities are held. So the entity or the company that is emitting securities is called the issuer, and the person or the company that is giving the money is called investor or investors. So, for example, we have here an investor, and the investor gives his money to this company or a government, because maybe this company or this government have the goal to create something or to invest in something, maybe in schools, maybe in become bigger than in the beginning. I don't know. They have a lot of goals, and for that reason, they need to raise capital. So investors lend money to this company in order to reach their goals. And then these companies or the government is obligated to return the money of the investor plus an interest during a certain period of time. In this example, is the period of time is 5 years. And another concept that we have is primary market and secondary market. Normally, this primary market and secondary market, these concepts are associated in centralized exchange or in a stock exchange. These formal markets that we were talking about. So, for example, in primary market, is because new stocks and bonds are sold for the first time. So this is the first step that the issuer needs to do, offer its securities through a primary market, because it's for first time. In a primary market, investor can purchase securities directly for the issuer. So imagine that a company is launching its first offer. So many investors could create deals directly with the issuer, directly with this company that is emitting debt or equity. And this initial public offering is called IPO. So when you have the opportunity to hear IPO, it means that it's the first public offer in a primary market. An IPO represents a company's first major sale of equity security to the public. Because why? Because it's the first, and because probably the company needed to fill a lot of requirements to be listed in a stock exchange. And for that reason, this is a major sale of equity securities to the public. And market prices are often set beforehand. So all the securities and all the equities that the company is offering in this primary market has a beforehand price. But what happened with the secondary market? In the secondary market, the investor exchanged securities with another investor, because maybe in the primary market, some investor bought securities, and then when the time passed, they want to sell these securities, but the securities are sold investors to another investor. In secondary market, this is the main feature, the main characteristic in the secondary market, that the transactions are made only investor to another investor. And the next slides, we are going to review the impact of regulation and procedures used in trading securities. That is a topic very interesting and fundamental to understand that all trading and all securities needs a regulation. But now, for this first class, let's leave the presentation till here.
Okay, so this is a model, as I told you, financial securities markets. It's part of the level 6 of this course. So my name is Yuriko Hirota. I'm going to be your teacher. So in this model, the number of topics that we are going to review are three very interesting topics. Obviously, in each topic, we are going to discover a lot of concepts and a lot of things about securities markets. So basically, this is an overview of the course. We are going to have 2 lectures, depending on the content or depending on your doubts. But basically, on average, we are going to have 2 meetings. We are going to have a break after 1 hour of class, a break of 10 minutes. And then I include in this slide the evaluation, that basically is 1 presentation and 1 report. Both of them, they need to cover 1,500 words. And basically, the weight of every evaluation is 50% case of a study and 50% an essay. The rules of the lectures is you should participate on class, because this is the way in which I can see if you are understanding or if you want to go deeply in some of the topics. So additionally, is very important your participation, because obviously with participation the class is more funny, and obviously all the ideas could be very enriching. Please, if you don't understand something, ask me or send a mail to the school, and the school is going to send your doubts and your question and to be response. And as a third point, obviously this presentation will be shared with you, and obviously the recording too. So the presentation is a guide. Obviously the presentation doesn't contain a lot of all the information because it's a lot, but it's a very, very good guide to review the main and the basic topics and concepts. This is our calendar. As I told you, we are going to review 3 topics. My goal today is review 1 and 2, but the most important is go very, very slow and explain everything. So this is the main structure, but obviously, so if you need, we are going to spend more time in one topic than in another, depending on your understanding. In the first topic, we are going to review, understand different types of securities and trading. And in the second topic, we are going to understand the principles of investment theory, securities, and market analysis that are fundamental parts in this module. And in the topic number 3, we are going to understand the legislation and regulation controlling the financial services industry. That is, I feel that this is a complement when we understand the main concepts and how the securities markets work. Is very important to understand what are the laws and what are the regulations that rule this world, no? The securities market world. Okay, in the section 1, understand different types and trading of securities. We have 3 topics. So section 1 is divided in 3 topics. First, explain the different types of securities and associated concepts, because this is basic. Understand what is a security, different types of securities, what are their characteristics, what kind of securities are more complicated, what kind of securities offer more returns, or what securities are riskier than the others. So basically, we are going to go very deeply in the different types of securities. Then we are going to analyze the characteristics of each kind of securities. And then we are going to assess the impact of regulation and procedures used in trading securities. In this part, we are going to review some international bodies that are regulating these securities. So, what is a security? The terms of security refers a financial instrument. Basically, a financial instrument is a document that contains, that if we belong this document, it represents that we have a security, that we are going to receive something, a yield, a return, a dividend, depending on the type of security. But basically, it's a financial instrument, a document that this document guarantees that we are investing our money in a company or a certain market, or we are giving our money to receive something, you know. And obviously, this financial instrument, this document holds some time of monetary value, because at the end we are giving our money and obviously this money has a value. It could represent different things depending on the type of security, obviously. For example, a financial instrument could represent an ownership position. It means that we are part of a company, that we belong a share in a company. It also could represent a creditor relationship, because we have some financial instruments that represent that we are giving our money as a kind of a credit to the other part. So it could be a creditor relationship too. Or obviously, again, depending on the type of security, this financial instrument could represent an option of buying, or an option of selling, or an option to play with the value of the money, or to play with the value of the asset that is part of the financial instrument. But no worries, we are going to explain, we are going to discover when we have an ownership position, when we have a creditor relationship, or when we have an option. So all this kind of relationship could be presented in a financial instrument or in a security. There are primarily 3 types of security. Obviously, there are more than these, but basically, securities are divided in these 4 categories. Basically, these are the most important. And if you see these 4 categories, it's very easy to understand securities. One of these securities is equity. Equity provides ownership rights to the holders. So if you see here, equity means that we are the owner of a position inside of a company. Another kind of security is debt. In this debt represent a loan repaid with periodic payments and even with an interest rate. So in case of debt, if we have a debt security, we will have a creditor relationship. And then we have the 3rd category, that is a hybrid. Basically, it's a hybrid between equity and debt. So for that reason, hybrids combine these 2 aspects, these 2 characteristics. So we have the 3rd category is hybrids. We are going to review in a few moments, in a moment. And then we have derivatives. Derivatives is an option. It represents an option, because basically derivatives are contracts that decrease or increase depending on certain variables, depending on what are the variables that we are going to include in this contract, in a derivative contract. So, equity securities. Equity security represent an ownership interest held by shareholders in an entity, and a company, a partnership, or a trust. It doesn't matter which kind of company. Realized in form of share or capital stock, which include common and preferred stock. It means that equity securities will be divided in 2 groups, common and preferred stock. So when we are talking about equity securities, it's very important to know which kind of equity security, common or preferred stock. Equity security basically represent a financial asset that is part of a corporation. For example, if a company wants to do something, for example, buy equipment, but the company doesn't have money. So the thing that the companies used to do is to sell share to, and in this way, the investor could give their money to this company. The company could use this money to, for example, buy an equipment. And then after a certain period of time, depending on the performance of the company, the investor will receive their money and additionally a return. No, in this case, this return is called dividend. So it means that we as a investor, we can invest in companies. So we can give our money to companies to cover a goal that the company has. And then after a certain period of time, we will receive a money depending on the performance of the company. The most prevalent type of equity security is common stock. We are going to review common and preferred stock. What are the difference between these two types of equity securities? But the most common is, yes, the most basic or the most common is common stock. So holders of equity securities are typically not entitled to regular payments. So it means that if we are going to invest in a company through equity securities, through buying equity securities, we are not going to receive our money every month. For example, we are going to receive our money after 1 year because we need to wait till the company operates the whole year, and depending on the performance of the whole year, we are going to receive the money, the dividend. But we need to wait. We are not going to receive periodically a payment of this investment. So this is one difference between, for example, equity securities and debt securities. But in case of equity, we need to wait at least 1 year to see if the company has a good performance or a bad performance, if the company was profitable or if the company lost money. So we need to wait. In case of bankruptcy, they share only in the residual interest after obligations have been paid out to the creditors. So imagine if we invest in a company and we wait 1 year, and in this year the company realized that it's impossible to continue with the business, and the company goes to bankruptcy. So first, the thing that the company needs to do first is pay, for example, the employees, then pays debt and other creditors. And in the last part, the company will pay to the investors, the investors that invested in share or in common stock. So imagine if we have a list and this company goes to bankruptcy, first will be pay employees, then, for example, bank loans, then another creditors, and in the last part, the investors that has a common equity securities will be paid. So we are in the last part of this list. So it maybe would represent a bad part, because obviously the company, we don't have this preference, but at the same time, what happens if the company is very profitable? We are going to review a very good returns. So, but this is maybe this is a part that is not very good for the investors, but is part of the equity securities. So equity securities are divided in common stock and preferred stock. I'm pretty sure that you have heard about this concept. When for example in the news, or maybe in the news, in the TV or on the radio, or maybe in the newspaper, I'm pretty sure that you have heard about common stock and preferred stock. So common stock and preferred stock are part of equity securities. But what are the difference between of this type of securities? For example, in common stock, the financial instrument represent an ownership in a corporation. So is basically the thing that I was discussing, because we are giving our money to a company. So at the end, if we are giving our money in a company, we are investing in this company because maybe we believe that this company is going to be successful. So if we are giving money, so we are part of the investor of the company. So we have an ownership relationship. For example, in a common share represent a claim of profits. In this case, profits. These profits are called dividends and confer voting rights. For example, when we are investing in a common stock, it means that we can decide inside the corporation, inside the company. We can say, okay, the company should move to another model of business, or the company should do this and should do that. So we are participating in the decision inside the companies if we have a common stock. So if we have a common stock, we can decide inside the company. This is very close to the next point. Shareholders have the ability to exercise control over the corporate policy and management issues compared to preferred shareholders. As I said, we can say, okay, we need, because I am the owner of a common stock, I could decide who will be part of my board of directors, for example. Or I could decide if we are going to launch a new product. Or because I have a common stock, I could vote to close this operation, no? So, but only if we have common stock. Because we have the control, because we have this benefit inside the company, if we have common stock, common stock is riskier than debt securities or preferred stock. So because we are deciding, and because we have a very active participation inside the company, obviously common stock is riskier than other kind of securities, because at the end we are taking decisions, and to have this benefit, we have also a greater risk. So imagine if we took a bad decision, at the end we don't have the same risk, it doesn't make sense. So in this kind of a stock is very, very close the level of risk and the level of benefits. One benefit is that we can control, we can decide. This is our benefit, that is too good. But the part in the risk is that maybe we can lose a lot of money. So this is common stock. So remember, common stock in equity securities, the most important thing is that we have the right to participate in the decision, and we have the right to control the company. But what happened with preferred stock? Preferred stock is completely opposite. In this case, we don't have voting rights. We, as an investor, if we buy a preferred stock, it means that we cannot vote. We cannot take decisions inside the company. We only have the ownership or a preferred stock or of a financial instrument, and that's it. We don't have any participation inside the company. So, for example, in the decisions inside the company, we don't have any voice. We don't have the right to decide, to vote. For example, if the company decided, okay, I'm going to launch this new product, we cannot say, no, I'm not agree, because we don't have voice. In liquidation, in case of bankruptcy, preferred stockholders have a graded claim. It means that in this list that I was telling you, first, in a case of bankruptcy, the company will pay again employees and other debts, for example, bank loans, and then will be preferred stock, and after that, common stock. So we have one step before common stock. So it means that it means that in a case of bankruptcy, we will receive our money before the investor that have common stock. This is too good too, because obviously we are not taking decision, and if we are not taking decision, obviously it means that our money in a certain way is safe. It's safe to in case of a bankruptcy, as owners of a preferred stock, our money is kind of safe. Same as a common stock, the money that we'll receive after a certain period of time is called dividend. So this is the same in common stock and in preferred stock. The money that we receive is called dividend. The dividends are usually higher than those issued from common stock. Why? Because, for example, we are not taking a lot of decisions because we don't have voice and we don't have voting rights. So for that reason, we are going to receive our money with a return. Not in the case of common stock, because if the company lost everything, the investor with common stock probably wouldn't receive anything. But in case of preferred stock, at least we receive our investment. Preferred stock also gets priority over the common stock, as I told you. In this list, in case of bankruptcy or even in a bankruptcy, preferred stock investor will be paid before common stock. Now let's explain debt securities. A debt security represents borrowed money that must be repaid, with terms that stipulate the size of the loan, interest rate, and maturity of the renewal date. It means that basically debt securities work as a normal loan with the bank, but instead of the company goes to the bank, the company could decide launch a public offer, and in this case, instead the company receive the money from the bank, the company will receive the money from plenty of investors. But the way in which debt securities work is the same as a loan. For that reason, debt securities normally have established a size or amount of money, interest rate, and a period, not so extensive like in, for example, in equity securities. Normally this could be monthly or annually, depending on the terms of the financial instrument. So they entitle the holder to the regular payment of interest and repayment of principal. It means when we, for example, if the company wants to do something inside the company, for example, launch a new product or buy a new factory, or maybe invest in advertisement and social media, and for that goals the company needs money, the company could launch this public offer, and in this way the company could get money from the investor. But every month the company will be paid a certain amount of principal of this money that the company received from the investor, and additionally the company will be paid an interest rate. And this payment of principal and payment or interest, it doesn't matter if the company has a good performance or if the company has a bad performance. If the company has a good performance, this is fine. But if the company doesn't have a good performance, it doesn't matter. The investor will be receive the money, its money and its interest rate, depending. But this thing is not linked with the performance of the company. So as you see, debt securities is the same as a normal loan. And obviously this kind of debt security doesn't this kind of debt security don't include any voting rights. So we don't have the right to decide anything inside the company, because at the end we are going to receive our money plus an interest rate. So for that reason, if the performance of the company goes good, it's great for the company. If the performance of the company goes bad, we are going to receive the same amount of money and the same amount of interest. So for that reason, we don't have voting rights. Debt securities could be secure or unsecured. For example, if they are secure, we can establish in the contract, in the debt securities contract, a point in which we are going to be prioritized over unsecured securities. So basically, this is the difference between secure and unsecured. With secure debt securities, we have the priority to be paid. Where some of examples of debt securities includes, for example, government and corporate bonds. Imagine, for example, if the government wants to create schools, but the government doesn't have money. So the thing that the governments used to do is to launch an offer of debt security. So obviously investor will give their money and the government could create these schools. So these kind of instruments, for example, government and corporate bonds, are not very risky. And obviously, because are not very risky, they don't offer a lot of interest rate. So because remember, always the interest rate and the risk are associated. So government bonds are not very risk, but obviously the returns are not very high. But I always have thought that this kind of bonds are perfect. For example, if you want to invest in a basic financial instrument, maybe you have an excess in your money, or maybe you have savings. So this government and corporate bonds is very advisable, because you are investing your money, but with a very, very little risk. And because in case of a problem, the government we will respond. So basically, government and corporate bonds are very secure. And another kind of debt securities are certificates of deposit, that is basically very similar to government and corporate bonds, but this could be obviously they are launched not for the governments, they are launched from another kind of companies, no? But basically they offer interest rate not so high, but at the same time the risk is not too high. And another is collateralized securities, for example, CDOs and CMOs. That is a more complicated financial instrument, but basically these are some of the examples of debt securities. And then we have hybrid securities. Hybrid securities are a combination between equity and debt securities. Example of hybrid securities, for example, we have equity warrants that are options that are launched by the company that give the shareholders the right to purchase a stock in a certain period or in a certain price. No, equity warrants is like it's equity, because at the end we are as an investor, the investor is buying a share, but in a certain time, in a specific price, as a debt security. Or we have another example of hybrid securities, that is convertible bonds, that these normally work after a certain period of time. If we are the owner of a debt security, for example, a bond, if we are the owner of a bond, in a certain period of time, we can decide if we change this bond for a common stock or not. So this is obviously, if we change to our debt security to a common stock, obviously this is an hybrid, because first we will have under the debt securities condition, and then if we decide to change this debt to a common, we are going to be under the common stock features or characteristics or benefits and obligations. So convertible bonds start being as a debt, and then they could change to be equity securities. And then we have preference shares. In these preference shares, accompanying a stock whose payments of interest, dividends, or other returns of capital can be prioritized of those of other shareholders. This is very similar, for example, as a preferred stock, but the difference is that in these preference shares, the investors are receiving interest as a debt security. So for that reason, because these three examples, equity warrants, convertible bonds, and preferred shares, combine the characteristics of equity and debt securities, for that reason, this group of securities are called hybrids. And then we have derivative securities. Derivative securities, same, I'm pretty sure that you have heard about derivatives, but not a lot of people know about derivative securities and how they work. So derivatives, keep in mind that derivatives are financial contracts. These are not like, for example, in equity, debt, and hybrid securities, that in the document we have a value of the money. In these derivatives, basically, is a contract with certain conditions. I mean, the contract doesn't have value as, for example, a common share or a debt security. The document doesn't have a value. In derivatives, the contract only have the condition. The thing that has the value is the underlying asset that is established in the contract. It means when we are working or when we are buying or selling derivatives, we are under a contract, and this contract has underlying asset, and this underlying asset is going to react. The value of this underlying asset is going to be determined depending of different variables. Could be the interest rate, could be the behavior of the markets, could be, for example, the fluctuation in currencies. So basically, but derivatives only are contracts with conditions. But let's review the slide. Derivative securities are financial contracts set between two or more parties. So in fact, we could have more than two parties, more than one person when we created this derivatives contract, whose value is dependent on an underlying asset. Again, the contract doesn't have a value. The value is the underlying asset that is included in the contract. Underlying asset or group of assets or a benchmark. For example, asset stocks such as stocks, bonds, currencies, interest rate, market indices, and goods. These underlying assets are going to move according these two variables: assets, bonds, interest rate, markets, index, and goods. And for that reason, the underlying asset, the value on the underlying asset is going to be changed. So we cannot say in derivatives contracts, okay, the underlying asset, the value of the underlying asset is 100 pounds. No, we cannot say that. We can say it's 100 pounds, but then it will, but this is not the final the final price of the asset. The final price of the asset is going to depend on another variables. If the market, for example, increase, the price of the underlying asset will increase. Or if the index, or if a certain index decrease, the value of the underlying asset will decrease, because the underlying asset is going to move according to these variables. Traders use derivatives to access specific markets and trade different assets. So derivatives are important because let the investor or let the traders to participate in a market that maybe are not very developed. So very developed, and or for example, imagine we have a market with certain kind of financial instruments, but we don't have a market with another kind of instrument. So derivative securities are very useful to trade different kind of assets. It doesn't matter if there is a market or not, because basically this is a function of the derivatives contract. Create a new market to trade securities. The most important market to trade derivative securities is the Chicago Mercantile Exchange. This is an example, and this is the largest derivatives exchange. Before to enter to derivative securities, I would like to take a break because I don't want to start this topic and then stop, because I would like to tell you the different type of securities in together, and for that reason, let's take 10 minutes break, and then let's get continued with all kind of derivative securities. So we will be here in 10 minutes for 55 to give you all kind of derivative security.